Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates with your financial market video, and yes, I'm back from vacation. It is Wednesday, the 2nd of January, 2019, about 4:10 p.m. Central Standard Time. Happy New Year to one and all. Appreciate you putting up with me taking a little private time. Needed it. Went to a beautiful city, Nashville. Had a great time there. Never been there. What a good city. In looking at the marketplace, while you're seeing green on the settlements, if you go to some of my earlier videos about 20 minutes ago, you'll see these markets were lower right across the board. Apple had come out with some forward guidance that didn't help. And remember, your settlement price is at 3:15 p.m. Central Time on stock indices, but they trade till 4 o'clock. So the last quotes here, you're up 57. You were down about 120 at the last quote. So it'll be interesting to see how the market reacts. Gold was up on the last quote of the day, $5. It settled 280 higher. And as you can see, a real mixed picture and difficult one in the currency markets. So what is going on? Well, as you can see, you've had a bounce, and that's about all I can say on the weekly charts. From where you're at. This is where you finished out in 2017. Now I can at least put on the chart and get rid of that as to where we're at now. But we were down for the year. Not a pretty year in the stock indices. When we take a look today at how the market is, even though you have an outside day up, you were up 575, you took out Fridays, this would be Mondays. Mondays high and low. I'm telling you, at the end of the day, you're going to drop tonight when you reopen unless something new happens between now and 45 minutes from as I'm taping this. That doesn't mean that this pattern's not good, but let me give you the ugly part of it. If today's low is taken out, then you're taking out the low of an outside day up, which often means that this is a bull trap. So what I don't want to see if the market's going to act good is today's low taken out. In terms of the swing line action, if we look at today's high, it was 25.21 and a quarter. Did not take out 25.23 that was made 2 days ago. So I'm still with the pattern here of, actually, because of how you settled, I got to take that arrow and put it back there. That's what should be done. And I would be arguing that I've got a pattern of lower highs but higher lows unless this low is taken out tomorrow or the next day. Do we understand that? It's lower highs, higher lows. That's just because of where you ended up settling as I began recording all these. As we take a look at the resistance, it comes in at the 18-day average of closes, 25.47, which tells me this rally that we've had from 23.16 is still to be labeled no more than a bear market rally. It is not a change of the picture yet. What the market did is when it broke out to the downside over the Christmas period, it rode that lower Bollinger Band, got to an extreme, and bounced away. In terms of momentum, what started the rally was this. If you come right here, this is the day I want, and that day is December 24th, the day before Christmas. If we take a look, you've got both numbers right here. Both numbers are still under 20. You see that? Under 20, and we'll go forward. So the first day under 20 is here, December 18th. The second day in a row is right here. The third was the 20th. That's called embedded. Embedded means the pros, in my opinion, and the way that I teach charting, will be aggressive sellers on the market until the red line closes back over 20. When it closes back over 20, prices often make a run back towards the 18-day average of closes. They don't have to hit it, but they often make a run really sharply at it. You can see right here, you lose the embedded reading. That is the day after Christmas, December 26th. So here's your first leg of the rally. There's your second. Here's your other part, and this is where you go today. That's what I call making your run at it. You're out of the momentum of downside. You lost that, and now the market's looking for what next is going to happen. When I come to the NASDAQ, it's the same darn thing. Here you lose, right here, the embedded reading. I know you get your rally there, and I'm looking for price in the 18-day average to make the run at each other, which they're trying to do, as you can see. When I come to the Dow, it's the same thing. I don't have to go back there and show it to each phase of it. And the same in the Russell. So you've lost the supreme bearishness that you had, but you haven't begun an uptrend just yet. That doesn't mean you'll even begin one. So far, this is a bounce off a market that broke hard. And again, I know it's hard for people to grasp it, but in the past what has worked is if the traders, and I'm talking the pros in the pit, I think, they're either writing and the futures, they're going short, or they're writing calls trying to get out at the 18-day average of close. The difference that's been happening, and I pointed this out to my subscribers while I was gone, is we have gone from 2017's tight bands in the, if you'll remember, in the VIX. We moved up a notch but kept the bands fairly tight in 2018, and the market ended the year with a burst getting up to 36. If you remember, a year ago, February, the market hit 50 on what we call that flash crash in the market, and everything exploded. This was sort of like that, but where did you pull back to? The 18-day average, and the market's looking for direction. In the bond market, would you believe 266 today on a 10-year note, and God knows about 3% in the bond? Weren't we just talking 3.5% or more in 10 years, and bonds going to go up, maybe mortgage rates exploding? Haven't seen that. It could happen, but we haven't seen it. And you can see how you're still pushing now to the point here where I'm concerned, because you're getting to this number where both numbers today over 80. They were over 80 on Monday, over 80 on Friday, day before. So what you've done here is you've hit your upside target with the embedded reading, and the market's just sort of hanging there. I am always fearful of buying over a Bollinger Band because you only stay over them 5% of the time. However, because you're embedded, until that red line closes under 80, I will say that on the pullbacks in this market, I still think the buyers are there in a big way. In TLT, this is overbought, not the same as you had on the other market. You lost an embedded reading right through here, and normally price and the 18-day average make a better run at each other than this market did. So this is one of those situations where the lost embedded reading did not pay off and make what I call a close enough run. You got near it, but that's not the way it normally works out. Today in the dollar index, a big outside day to the upside. Outside day means a couple of things. First of all, it's also a key reversal. What does that mean? If you take a look at current price action at the most recent highs, this was the most recent low, and then it went through Monday's high and low, closed higher on the day. So you've got a day that took out the previous low, high, closed higher, sharply higher on the day, and the lowest low of the break since back here in early December. So I'm going to call it a key reversal. Does it mean anything other than that? To me, no. I think you're basically still caught in between these Bollinger Bands looking for direction, and I think traders beyond imagination are confused and argumentative as to what the path for the US dollar is going to be in 2019. It's a big question, and one that will impact what the marketplaces do. Stronger, weak dollar. Emerging currencies, are they going to do better? Emerging markets, are they going to do better? Lots going to depend on the dollar, and it's neutral right here. And your attempt to try to break out a bit to the upside in the euro while I was gone, it didn't work at all. You're still caught in this sideways action, churning between that Bollinger Band high and possibly the low. Momentum down, at reversal day down in the market. You could call it almost a key reversal. British pound did all this fabulous work coming from here just over 125 all the way up to the upper Bollinger Band. What's the first thing I often teach? The first challenges of Bollinger Bands are where pros often take money off the table. I didn't say they get out of all their positions. I said they take money off the table. And look what the market did. It's just what I teach, and that's what I expect. Here, first challenge, they took money off, market still ran. The idea is you're looking at other things, but if you're looking more times than not and you hit these Bollinger Bands and you go back, you'll see a number of times. That's about it. Here you got a market that's in a run. Why? Because the yen is different. It's a safe haven. And what people are doing is they're not worried what's going on. This is a credit union country. I want you to remember that word. People throw their money into this currency to get away from other currencies. And that's what they're doing because they don't know what to do with the political and world economic events that are going on. In Bitcoin, I started laughing, and I'm still laughing. I'm laughing at some of these, and I'm not going to mention them, great gurus that were talking the 50,000. These same guys over the holidays have decided they're not going to put price targets on Bitcoin anymore. They're just saying it's going to be an asset class and it's a great investment. Yeah, if you wait a couple of years from your $15,000, $20,000 run up, that's it. Or is it a tulip? Remember the tulips? They weren't worth anything after a while. I don't know. I see basing action. I'm the first to agree with that. A chart's a chart to me. I don't care. I've got neutral momentum. I have a pattern of lower highs and higher lows. I don't have a trend. Seems to be stuck here. When I take a look at March Brent versus March WTI, and the reason I'm using the word March for both is I think February is still where the WTI crude and the product should be traded, but that's going to go away in a few days. But right now, when you look at that, you see how the spread came in from over 9.25 to right here into the 760 level. It's right now trading about 805. One of the things we're seeing is because crude oil prices have fallen so much, we're not getting, number one, all that oil from Saudi Arabia going forward that we used to get. Number two, why not use our own oil? Makes up for the shipping when you're this low, and I think that's part of what's going on. When I was asked today on Bloomberg what I thought about crude, if you were me and you saw an embedded reading that was lost, watch this, are you bullish or bearish? And this is as of Friday's close. I know today, Wednesday, they're asking me, and I'm saying, and I wrote it in my news report this morning, I wouldn't be surprised if we'll make a run to the 18-day average of closes. I don't know if we'll do it or not, but we're darn close. So, number one, I'm not as bearish as the other traders. Number two, low prices take care of low prices. In other words, you stop producing as much or other people stop producing it, and then you got a problem. That creates a higher price. WTI crude, the lower low, higher high, lost embedded reading, and you're still, I think, headed towards that 18-day average of closes. Knock, knock, knock on the door in gasoline. By the way, did you see the range in gasoline today? 11 cents a gallon. So if you're trading it, and let's assume it's $400 a cent in the futures, it's a $4,000 move. I don't have that tolerance level if I'm wrong. But all I'm looking at is the 18-day average of closes. And that's where I think you're back to neutrality in the market. And that's where I think this market's headed. When we look at nat gas, you have the embedded reading, the lower highs, lower lows that have been in place for a while with the embedded reading. So seeing prices fall, yeah, weather will change this. This is a son of a gun market to try to trade in the months of December, January, and February because the cold snaps can come and go on you and you're left wondering what's going on with me. But you're bearish and still staying very much in the bear camp on that. You know, I write about all this, and you'll see a lot more if you go to my updates. And how do you get to them? Well, you need a password, user ID, or I mail them to you. You can call my staff to get a free trial. You can go to our website, sign up on our free offer page right on the front page of it, or you can click here. It'll take you right to the area that you sign up. I'm Ira Epstein. Happy New Year to all. See you tomorrow.